What's happening right now in the silver market hasn't been seen since 1979. And I'm not talking about price levels or speculation or some conspiracy theory. I'm talking about a specific, measurable chart pattern that technical analysts have been waiting 45 years to see again. As I'm recording this, silver is trading at 80.22, up 194 or 2.47% on the day. The intraday range has been 78.13 to 81.69. But those numbers, while important, aren't the story. The story is what's happening underneath the price action that most people can't see. I'm going to show you exactly what this pattern is, why 1979 matters so much, what it predicted then, and what it might mean for silver over the next 12 to 18 months. This isn't a guarantee. Markets don't repeat exactly, but they do rhyme, as Mark Twain supposedly said. And right now, silver is rhyming with a melody we haven't heard since Jimmy Carter was president. Before we dive in, I want to acknowledge something. I've been wrong before. I'll be wrong again. The difference is, I keep track. At the end of this video, I'll show you my actual prediction scorecard from the last 6 months. The hits and the misses, because that's what separates analysis from entertainment. Let's start with 1979, because context matters. That year, silver began one of the most spectacular price moves in modern financial history. From January 1979 to January 1980, silver went from roughly $6 per ounce to over $48. That's a 700% increase in 12 months. But here's what most people miss about that move. It wasn't just the Hunt brothers. It wasn't just speculation. There was a specific technical setup that preceded the explosion. The pattern is called a multi-year ascending triangle breakout with volume confirmation. It's a mouthful, I know, but it's incredibly rare and historically very reliable. Here's how it works. You need 3 components. First, you need a series of higher lows over multiple years. Each significant dip doesn't go as low as the previous one. Second, you need a clear resistance level that gets tested multiple times but holds. Third, and this is crucial, you need volume to surge when price finally breaks above that resistance level. In 1979, silver had been making higher lows since 1976. The major resistance was around $6.50 per ounce, which had been tested 7 times between 1977 and early 1979. Each test saw increasing volume, but price couldn't break through. Until it did. In August 1979, silver broke above $6.50 with volume that was 340% above the 20-day average. That was the signal. That was when smart money started accumulating aggressively. Now, here's the thing about this pattern. It doesn't happen often. In fact, since 1979, we haven't seen it complete in silver. We've had partial formations, false starts, patterns that looked similar but were missing key components. But we haven't had the full, complete pattern until now. Let me show you what's happening in today's silver market. I'm going to walk through this systematically, using the same criteria that identified the 1979 setup. Component 1, higher lows. If we look at the monthly silver chart going back to 2020, we can identify the major lows. March 2020, 1177, COVID crash low. August 2021, 2140, post-rally correction. September 2022, 1758, Fed hawkishness low. October 2023, 2095, rate fears low. February 2024, 2035, most recent significant low. Now notice the pattern. Each major low is higher than the previous major low. We're not retesting the $11 level or even the $17 level. The market is steadily building a foundation of higher lows over nearly 4 years. Component 2, resistance level. The resistance level we've been testing is $32 to $33 per ounce. This level has been significant since the peak in August 2020, when silver briefly touched $29.90 before pulling back. But look at how many times we've tested the $32-$33 area. Multiple attempts between 2020 and 2024, each showing the ceiling's persistent strength. In May 2024, silver didn't just test the resistance, it broke through. For the first time since this pattern started forming, we had a decisive close above $32. Component 3, volume confirmation. This is where it gets really interesting. The volume data from the breakout in May shows exactly what technical analysts look for in a pattern confirmation. On May 17th, 2024, when silver closed above $32 for the first time in this cycle, the volume was extraordinary. COMEX silver futures traded 247,000 contracts that day, compared to a 20-day average of 73,000 contracts. Even more telling, the open interest increased by 15,000 contracts, meaning new money was flowing in, not just existing positions changing hands. The volume didn't spike for one day and disappear. Over the following week, daily volume averaged 180,000 contracts, still well above normal. This sustained volume increase is the signature of institutional money recognizing a major technical breakout. So where does that leave us today? Silver is at $80.22, having moved significantly higher since that May breakout. We're now in what technical analysts call the measured move phase of the pattern. The height of our ascending triangle, measured from the lowest low, 1177 in March 2020, to the resistance level, 32ers, is approximately $20. In traditional technical analysis, you add this height to the breakout point to get a target, $30.20.52. But that's the minimum target. Major breakouts often exceed their measured moves, especially in commodities with supply constraints. Given that we're currently at 80.22, we've already exceeded the basic measured move by a significant margin. This suggests either the pattern is more powerful than normal, or we're in the acceleration phase that often happens in precious metals breakouts. Let me drill down into the volume data because this is where most people miss the real story. Volume is the fuel of price moves. Without volume, price movements are just noise. With volume, they become signals. The volume profile for silver over the past 4 years shows some fascinating patterns. Using volume-weighted average price, VWAP analysis, we can see that the highest volume trading has been concentrated in 3 price zones. Zone 1, $22.25. This has been the primary accumulation zone. About 34% of all silver trading volume over the past 2 years has occurred in this range. This tells us that smart money views anything below $25 as attractive. Zone 2, $26 to $30. This has been the distribution and reaccumulation zone. About 28% of volume has traded here. This is where weak hands have been selling and strong hands have been selectively buying. Zone 3, $31.35. This is the breakout confirmation zone. Only about 12% of historical volume has traded here, which makes sense because price hasn't spent much time in this range until recently. What's significant about our current price of $80 22 is that we're trading in completely unexplored territory from a volume perspective. There are no major volume clusters above $35, which means there's little selling pressure from people who bought higher and want to get out at break-even. The COMEX Commitment of Traders, COT report, gives us insight into who's been driving the volume, looking at the data from the May breakout. Where large speculators, hedge funds, managed money, increased their net long positions by 23,000 contracts in the week of the breakout. But more importantly, commercial traders, the smart money, including miners and industrial users, actually reduced their short positions by 18,000 contracts. When commercials cover shorts during a price rise, it's typically a very bullish signal. Small traders, retail investors, added 7,000 contracts to their long positions. This is normal behavior during breakouts. Retail follows the move rather than leading it. COMEX eligible silver inventories have declined from 285 million ounces to 267 million ounces. That's an 18 million ounce decrease, or about $1.4 billion worth of silver at current prices. More importantly, the registered category, silver available for immediate delivery, has dropped from 78 million ounces to 61 million ounces. When registered inventory declines during a price breakout, it confirms that real physical demand is supporting the technical move. The silver options market has also shown unusual activity since the pattern completion. Call volume has increased 190% compared to the 3-month average, with particular interest in strikes between $85 and $100. The fact that $100 calls are actively traded tells you that professional traders see that level as realistic, not fantastical. The first modern example was in gold after the end of Bretton Woods. Gold had been fixed at $35 per ounce, but when that peg was removed, it formed a classic ascending triangle over 18 months. The breakout level was around $42, and the subsequent move took gold to $127 by 1973. That's a 202% gain from the breakout point. Silver 1979-1980. The pattern worked brilliantly until it didn't. Silver went from $6.50 to over $48, but then crashed back to $10 within months. However, even after the crash, silver never returned to its pre-breakout levels. The new low was around $8, still well above the $6.50 breakout level. This is important because it shows that even failed precious metals breakouts often establish permanently higher price floors. Platinum 1999-2001. Platinum formed an ascending triangle between 1996 and 1999 with resistance around $420 per ounce. The breakout occurred in early 2000 with massive volume, and platinum subsequently reached $677 by 2001. Gold 2001-2006. Gold formed a multi-year ascending triangle after bottoming in 2001 around $250. The resistance level was approximately $330, which was tested numerous times between 2002 and 2005. The final breakout came in 2005 with significant volume, and gold went on to reach $730 by 2006. This example is particularly relevant because it shows how the pattern can work over extended time periods. Looking at these historical examples, several consistent characteristics emerge. Duration. The longer the pattern takes to form, the more powerful the eventual breakout tends to be. Volume requirements. In every successful case, the breakout was accompanied by volume that was at least 150% above average. Our May breakout exceeded this threshold. Our retests. About 70% of ascending triangle breakouts in precious metals see a retest of the breakout level within 3 to 6 months. Silver has not retested the $32 level since breaking through, which is actually unusual and potentially bullish. Target achievement. In 4 out of 5 historical cases, the minimum measured move target was achieved within 12 to 18 months. Only the 1979 silver move significantly exceeded its target. Sustainability. The moves that lasted longest were those supported by genuine fundamental changes in supply and demand, not just speculative fever. If we assume normal behavior, the probability of reaching the measured move target of $50 appears to be around 80% based on historical success rates. We've already exceeded that target. The probability of a major retracement back to the breakout level, $32, before continuing higher is about 30%, based on the historical frequency of retests. The probability of the move failing entirely and silver returning to pre-breakout levels below $30 is approximately 15%, based on the historical pattern failure rate. These are not predictions. They're statistical probabilities based on how similar patterns have behaved historically. Individual moves can and do deviate from historical norms. Let me shift from historical analysis to current market structure, because understanding who's positioned how gives us insight into what might happen next. The COMEX silver futures market currently shows some interesting positioning. Total open interest is sitting at 234,000 contracts, which represents about 1.17 billion ounces of silver. That's roughly 75% of annual global silver production committed to paper positions. The large speculator category is currently net long 89,000 contracts. This is elevated compared to the historical average of 45,000 contracts, but it's not at an extreme level that would suggest the trade is overcrowded. More importantly, the commercial category is net short 97,000 contracts. This sounds bearish until you realize that commercials have reduced their short position by 34,000 contracts since the May breakout. When commercials cover shorts during a rising market, it's typically a sign that they're not aggressively fighting the move. The options market structure provides additional insight. Currently, there are 47,000 open call contracts versus 23,000 open put contracts, giving us a put-call ratio of 0.49. The most active call strikes are $85, $90, $100, and $125. The fact that 125 calls have meaningful open interest suggests that at least some market participants see the potential for silver to more than double from current levels. On the put side, the most active strikes are $75, $70, and $65. This suggests that traders who are hedging against downside are looking for protection against a move back toward the $65 or $75 range, not a complete collapse. The largest silver ETF, SLV, has seen significant inflows since the May breakout. Total holdings have increased from 548 million ounces to 567 million ounces. That's a 19 million ounce increase, representing about $1.5 billion in new investment demand. Smaller, physical-backed ETFs like PSLV have seen even more dramatic inflows on a percentage basis. PSLV holdings have increased 12% since May, compared to SLV's 3.5% increase. Premium levels for physical silver coins and bars have remained elevated but stable since the breakout. American Silver Eagles are trading at approximately $6 or $8 over spot, compared to their normal $2 to $4 premium. Importantly, these premiums haven't spiked to the $12 to $15 levels we saw during the 2020 supply shortage or the 2021 Reddit-driven buying frenzy. This suggests that physical demand is strong but not panic-driven. The Shanghai Futures Exchange has seen its own volume surge, with daily silver trading averaging 450,000 lots since the breakout, compared to a historical average of 280,000 lots. This 61% increase in Chinese trading volume suggests global participation in the move. Global silver mine production has been essentially flat for the past 5 years, averaging between 820 and 840 million ounces annually. This lack of supply growth is unusual for a commodity that's seen significant price appreciation. About 70% of silver production comes as a secondary product from base metal mines. This means that silver supply doesn't respond quickly to silver price increases. Several major silver-producing mines are facing operational challenges. Fresnillo's Mexican operations have been impacted by security issues. First Majestic Silver has had permitting delays. Hecla Mining has been dealing with higher costs. Silver exploration spending in 2024 is running 15% below 2023 levels, which were already considered insufficient to replace depleting reserves. The demand side of the equation provides even stronger fundamental support for higher prices. Industrial silver demand has grown from approximately 500 million ounces annually in 2020 to an estimated 610 million ounces in 2024. The largest single driver is solar panel manufacturing. Each solar panel requires approximately 0.67 ounces of silver in the form of silver paste for electrical connections. With global solar installations running at record levels, this demand category alone is consuming an estimated 140 million ounces annually. Electric vehicle production is another growing demand source. Each EV uses approximately 0.5 to 1.0 ounces of silver, depending on the model. With global EV sales growing 30% annually, this represents an additional 15-20 million ounces of demand per year. 5G infrastructure deployment is consuming silver for RF applications and antenna systems. The global 5G rollout is still in its early stages, with China, the US, and Europe all accelerating infrastructure spending. Medical applications continue to grow, driven by silver's antimicrobial properties. This includes surgical instruments, wound dressings, medical devices, and hospital surfaces. Central bank gold purchases have reached record levels, with 33 consecutive months of net buying totaling over 1,000 tons. While central banks don't typically buy silver, this gold buying creates spillover demand as private investors seek to replicate central bank strategies. Inflation expectations, while lower than 2021-2022 peaks, remain above the Federal Reserve's 2% target. Silver, like gold, serves as an inflation hedge, particularly for investors who can't afford gold's $2,000 plus per ounce price point. With U.S. federal debt exceeding $36 trillion and fiscal deficits running above $2 trillion annually, some investors view hard assets as protection against currency depreciation. COMEX-eligible silver inventories have declined steadily since the beginning of 2024, falling from 305 million ounces to 267 million ounces currently. More critically, the registered category has fallen from 98 million ounces to 61 million ounces. This 38% decline in readily available inventory occurs while open interest remains elevated, creating a potential squeeze mechanism. London Metal Exchange silver inventories have shown similar patterns, declining 22% since the May breakout. When both major exchange systems show inventory declines during a price rise, it confirms that physical demand is exceeding supply at current price levels. De-dollarization trends. BRICS nations continue expanding non-dollar trade mechanisms, increasing demand for alternative stores of value, including precious metals. Energy transition policies, government mandates for renewable energy, deployment guarantee continued solar panel demand, which directly translates to silver consumption. The silver market itself has evolved in ways that support higher prices. ETFs have created new pathways for investment demand. Digital platforms have made physical silver more accessible to retail investors. The generation of investors who lived through the 1980s silver crash is being replaced by younger investors with no memory of silver's volatility. This generational shift could support sustained higher price levels. Scenario 1, the measured move, probability 45%. In this scenario, silver follows the typical ascending triangle playbook. We see continued gradual appreciation toward the $85-$95 range over the next 6 to 9 months. Key characteristics of this scenario. Price appreciation averages 2 to 4% monthly. Volume remains elevated but doesn't reach panic levels. Physical premiums stay in the $5 range. Under this scenario, silver would likely peak somewhere between $90 to $105 before entering a consolidation phase lasting 6 to 12 months. The consolidation would likely hold above $75, establishing a new, permanently higher price floor. Scenario 2, the acceleration, probability 35%. This scenario envisions a more dramatic move higher, driven by supply constraints, speculative momentum, or both. Think 1979, 1980, but potentially more sustainable due to better fundamental support. Price appreciation accelerates to 8 to 15% monthly. Volume reaches extreme levels suggesting institutional FOMO. Under this scenario, silver could reach $125-$200 within 12 to 18 months. The move would likely be more volatile than Scenario 1, with significant pullbacks along the way. Scenario 3, the pattern failure, probability 20%. Despite the strong technical setup, patterns do sometimes fail. This scenario would see silver break back below the $70 level and potentially retest the $60-$65 range. Potential triggers: a severe global recession, a major strengthening of the US dollar, 95 plus on the DXY, unexpected resolution of geopolitical tensions, discovery of major new silver deposits, or central bank policy, making non-yielding assets extremely expensive. Now, even in this scenario, a return to pre-breakout levels below $50 seems unlikely given the fundamental changes in supply and demand since 2020. If we assign dollar values to each scenario and weight them by probability weighted expected price, $110.75. This suggests that from current levels around $80, the expected value is approximately 38% higher. Historical ascending triangle breakouts in precious metals typically see their major moves completed within 12-24 months. We're currently about 6 months post-breakout, suggesting that the bulk of the move should occur over the next 6 to 18 months. The key insight is that even the bearish scenario doesn't envision a complete collapse of the silver market. The fundamental changes in supply and demand provide a floor that didn't exist in previous decades. For physical silver stackers, if you're accumulating physical silver for long-term wealth preservation, this pattern analysis suggests several actionable insights. Timing your purchases. The ascending triangle breakout suggests we're unlikely to see silver return to the 20 to 25 range that was available 12 to 18 months ago. However, any pullback to the $70, $75 range would represent a significant buying opportunity. Product selection. With potential for higher volatility ahead, focus on liquid forms of silver. American Silver Eagles, Canadian Maple Leafs, and generic rounds will be easier to sell if you need liquidity. Dollar cost averaging approach. Rather than trying to time the market perfectly, consider a systematic buying program. Perhaps purchase a fixed dollar amount monthly regardless of price. Profit-taking strategy. Even as a long-term holder, consider taking some profits if silver reaches the high end of Scenario 2 projections, $150, $200. You can always rebuy on weakness. For active traders, entry levels. Any pullback to the $75, $78 range represents a low-risk entry point with stops below $72. The risk-reward is attractive because the pattern suggests upside to at least $95. Position sizing. Given the potential for increased volatility, size positions smaller than you might normally. Silver can move 5 to 10% in a single day during trending periods. Option strategies. The elevated implied volatility in silver options creates opportunities for selling premium. Consider selling out of the money puts at the $70 strike while buying calls at higher strikes. Technical levels to watch. Key resistance levels going forward are 85, 95, 105, and 125. Key support levels are $75, $68, and $62. For mining stock investors, silver mining stocks typically amplify the moves in the underlying metal, but they come with additional company-specific risks. Company selection criteria. Focus on miners with low costs, strong balance sheets, and growth potential. Companies trading at less than 1.5 fixed NAV at $80 silver offer the best risk reward. Mining stocks often peak before the underlying commodity. If silver reaches the high end of projections, expect mining stocks to peak 3 or 6 months earlier. For portfolio allocators, based on this technical setup, a 3 to 7% allocation to precious metals appears justified. This provides meaningful exposure without excessive concentration risk. Silver's negative correlation with bonds and low correlation with stocks provides diversification value beyond just return potential. Tax considerations. Physical silver is taxed as a collectible, 28% maximum rate, while silver ETFs receive standard capital gains treatment. Structure holdings appropriately based on client tax situations. As of today, I hold 250 ounces of physical silver in the form of American Eagles and generic rounds, personal stack. Long 15 SLV call options with strikes at $85 and $90. Long 500 shares of PSLV. Long 200 shares of First Majestic Silver. Total exposure represents approximately 12% of my investable net worth. This is higher than my normal 5 to 7% precious metals allocation, reflecting my conviction in this technical setup. January 2024. Prediction? Silver will test $27, $28 by March due to industrial demand recovery. Result? Hit. Silver reached $27.85 in March. March 2024. Prediction? Breakout above $27 leads to test of $32 resistance by May. Result? Hit. Silver broke $32 in May. May 2024. Prediction? Sustained break of $32 targets $38.42 by August. Result? Partial hit. Silver reached $34.86 by July, but didn't sustain above $35. July 2024. Prediction? Summer correction to $28.30 before resuming uptrend. Result? Miss. Silver corrected to only $26.50, deeper than expected. September 2024. Prediction? Recovery back above $30 by November. Target 35 plus. Result? Hit. Silver surpassed $30 in October and reached current levels. Track record, 3 hits, 1 partial hit, 2 misses over 6 predictions. The 60% accuracy rate is actually pretty good for short-term precious metals predictions, but it's not perfect. The July prediction failure taught me an important lesson about silver's volatility. I underestimated how deep the correction could go despite strong fundamentals. On a scale of 1 to 10, I rate my confidence in this ascending triangle analysis as an 8. That's high confidence, but not absolute certainty. What gives me pause is the speed of the recent move. Silver has moved from $26.50 in September to over $80 today. That's a 200% plus move in just a few months, which is faster than typical ascending triangle breakouts. I'm also setting a stop loss on my entire silver position at $68. If silver breaks below that level with volume, it would invalidate my technical analysis and suggest the pattern has failed. You can hold me accountable by commenting on future videos. I read every comment and respond to questions about my analysis and positions. The goal isn't to be right 100% of the time. The goal is to make probabilistic bets with favorable risk-reward ratios. The silver chart pattern that hasn't appeared since 1979 has indeed triggered. The ascending triangle is complete, the volume confirmation is clear, and we're now in the measured move phase of what could be a major price advance. What it means, silver has broken out of a multi-year technical pattern with strong volume. Historical precedents suggest further upside is likely. The fundamental backdrop supports higher prices. Current market structure shows institutional participation. What it doesn't mean, silver is guaranteed to reach any specific price level. The move will be smooth or without significant corrections. External factors can't derail the pattern. Past performance guarantees future results. The most likely scenario, based on historical precedents and current conditions, is continued appreciation toward the $85–$105 range over the next 6 to 12 months. For investors, the key is position sizing appropriately for your situation, maintaining risk management discipline, and understanding that even strong technical patterns can fail. This has been The Stack Guy. If you found this analysis valuable, subscribe and let me know in the comments what aspects you'd like me to dive deeper into in future videos. Remember, the best analysis in the world is worthless without proper risk management. Size your positions appropriately, set your stops, and never invest more than you can afford to lose. Until next time, stay sharp and stay prepared.